I would not hire a home inspector that my agent provided, because is that home inspector going to worry about your business or your agent's repeat business? So if
Yes.
there's just enough in the subjective realm of this property that might make it to where you don't want to buy it, will that home inspector put all of that down because it could ruin their relationship with your agent? Or will they fuzzy that area subconsciously to not ruin their relationship with your agent, to make it so that you'll follow through with the deal? Find your own home inspector, have them make sure they have your interests, not your agent's interests at heart. And I'm not saying there's anybody unethical out there. I'm saying we're humans. Part of this could be subconscious. And so it's not that hard to go find your own. Howdy. Welcome back to One Rental at a Time. The timeline of buying a rental property, more of a instruction manual, a how-to video on what is it actually like in chronological order to buy a rental. I did a video like this about 2 or 3 years ago on my channel. And the first response from the brightest person that I've encountered on YouTube said, why would you take all of the time to explain what it's like to buy a rental? Every step that you talked about was the exact same process of buying a house.
Ta-da.
Exactly. You're buying a house. It's just going to be a rental. So let's go through the chronology on this. And there's a few things that we do before buying, we do while we're buying, and we do before we buy the next one. And Matt, you've done this process a few times.
Couple.
And you're how many properties now?
52 buildings, 140-ish units in market, and about 400 tenants. Done this a couple times.
Nice. How many appliances did you have last count?
600. 600. We broke the 600 mark.
So you've done the process of acquiring properties a few times, and you've seen some changes over the years. There's been times when it's a buyer's market, a seller's market, and things might happen sooner or later, or be not done at all.
Yeah, sure.
Have you done an all cash purchase?
Yes.
Okay, so you've seen that that's 5 sheets of paper instead of the 67 pages for a regular purchase.
It's about 7 minutes to close, and that's because you spent the first 4 talking.
And right, and the funny thing is with the sorry for the segue, but those 5 sheets was still a $200 mobile notary fee.
Yeah, exactly.
A discount because it was way less paper.
Yeah, I was like, I don't know that there's anywhere you can make more money than this per minute.
Right, no,
even doing illegal things. Yeah.
All right, so to buy a rental, now the things that are different with rental and house, right? If you're buying a house, you're considering usually payment, right? Home buyers buy based on payment. You're looking at location, amenities that you want to live there. Now, some people make the mistake of doing that when they're buying a rental. You don't live there, right? You may, worst case scenario, scorched earth, have to live in one of your rentals, right? But how often does that actually happen? So with a rental, we are looking at, I start with the first step most people stop at, math.
Yeah.
I want to know, am I going to get a good return on my money? So that is, am I going to invest locally in a high cost of living area at a distance, or for a different reason, find a better market or a market I plan on moving to, or all those things. When we're looking at renting, math is just step one, right? To the chronology of buying a rental for me, you have to learn your market.
Yep.
You have to learn your asset class.
Yep.
Right. So I know that an instruction manual video would be like, well, you make an offer, it's accepted or rejected. No, it's how do you study your market to figure out what is a good deal to pursue?
Sure.
So that you know which offers you can make.
Sure.
And then when you study your market, you have to figure out, does your asset class work there? Right. So I wanted single family houses to start. I have still in a decade not seen one that would cash flow as a purchase to be in a rental here. So I went to small multifamily. I shifted my strategy, my asset type into the market to make it fit. Now, there are other markets where single families are the way to go. I know that you've recently, I think you're down to your last one to sell, or do you have 3?
Yeah, we literally have a couple of single families, and they're both one of them just got finished and is on the market. And then we've got another one that's being finished and that's going on the market. Like, we just don't want to be in the single family game. And that's even owning them right, deal. That's owning them right. And it still doesn't make a whole lot of sense. Like, I don't want to grind it out for a few $100. I just don't.
I've got one single family house. And if it wasn't the one that I kept through the divorce, because math says I should sell it and redeploy the funds. But the little petty part of me is like, no, I'm gonna keep that one. Yeah. So, and we have to shift our strategy as it goes. When it comes time to make an offer on the chronology of buying a rental, it means you're ready, right? So you
Yes.
save the down payment, closing costs, money for immediate repairs, and you have the reserves lenders are going to require.
Mhm.
You've studied your market. You know how to recognize a good or great deal, right? When you've reached financial freedom and you don't have to buy, we talk about buying only great deals. And I know we're on the One Rental at a Time channel, and Mike talks about get the great deals. I think in the beginning it's okay to look at base hits. You're going to get the RBIs by having people on base. You're not. It's not going to happen unless you get those base hits, which means don't buy an alligator. Don't buy something that breaks even. Don't buy something where you have to factor in principal pay down, appreciation, and tax benefits to make it sound like you're making money. I mean, you want to go for at least base hits, which is positive cash flow and a good return on your money, which good is subjective to your investing strategy and the market that you're in. And there's some markets where a 4% return is a great return because most get negative or 1 or 2%. If you're in a higher market, you try to beat average. So now you can recognize those. You're not going through anything major in your life, right? No, no, you didn't just have a baby yesterday. You didn't, although when you've been investing for 23 years and you have a baby, you probably closed on a property that month too.
I did.
Wouldn't surprise me. Yes. You don't have a death in the family, a divorce, or just, I mean, maybe got married this week. Those big things that take your focus away from
Sure.
the actual logical steps it takes to determine if this is a deal worth pursuing. Now you go to make your offer. Okay, so this is the chronology, but how do you get to the offer point? Right. But so chronologically, to get to the offer, you have to be finding the deals.
Sure.
So what are some of the ways that you find your deals?
I mean, these are all kind of elite strategies, but we'll share them because, there is the way there is the way of Dion, and then there is the way of me. And we're just different in that regard. So, thankfully, because I couldn't teach what you do. But for us, we always keep track of our last 5 deals, and they are off market, wholesale. You're looking for inventive ways to not have created a bunch of competition. Largely speaking, my belief is unless you are a really good investor like Dion is, then doing MLS, you will likely either overpay or consistently lose. That's my belief in the first few years. So I think what is best, the best type of deals are the ones you create on your own. The way that you can create those on your own is like what multifamily strategy talks about with Christian, with really talking about relationship, understanding what other investors are in your market and learning and seeing what they're doing. It's always worth trying to have a conversation with them, and just say, hey, I know you have this building and this building, and I think they're amazing, and I'm getting into the business, and I would just love to have a quick conversation with you and try and earn some and glean some data from that. But one of the most tricky ways that I find deals is I actually look on the list that the city or town creates of people that are now getting fined for not having done maintenance or not having done something that they've been cited for at their property. Reason I love those deals is because why haven't they done the work? It's usually because they don't have the money to. Are they going to work? Are they going to do the work? Likely no. Are they likely a landlord that's been at it for some time? Likely they are. And then they're going to be the ones that understand a seller finance deal or be willing to at least have a conversation with you. At least have a conversation with you and say, hey, so, reason for my call is I actually own some property around town, saw your building, and was wondering if it's something you would ever consider having a conversation about. And you'd be shocked. The number of people that are willing to have that conversation. I backed out of a deal for 53 units. And that deal was created that way. I knew that they were getting fined. I knew that they were losing. I knew that they were getting fined in court by the city. I knew that they weren't fixing their stuff. I knew that they were in a fight with the city. And at the end of the day, we just couldn't meet on the number. Now, at the end of the day, did he close with anybody else? Nope. So I still reach out to him every 3 to 6 months because it is likely that eventually I could buy that portfolio and probably buy it with pretty favorable terms. Because at that point, he will have talked to everyone else, done with everyone else. Now somebody else might do a bad deal and buy that deal from him for what he wants. And the only way that that deal will get accomplished is if he seller finances it. But the terms just aren't agreeable. So I think if you look at doing things that way, I think if you look at finding innovative ways to find deals, look at that list. That's something that no one else on YouTube talks about. I've found deals that way. Wholesalers, seeing the ones in local and reaching out to them. All of those are opportunities. And even if you're just flexing your muscles and just getting your body used to the activity, that's still a good thing. You need to be doing that. Very rarely does somebody walk into a gym and start bench pressing, 225, 40 reps. You had to work your way up. So it's the same thing.
There are so many ways to find deals. Driving for dollars, mailers, wholesalers. I don't use any of them. Not one. All of my deals are from the MLS, all with conventional lending. When we talk about being different, mine is the lazy way. I was working full time, raising 3 kids, didn't have a schedule to do a lot of creative things. So all my deals came from the MLS. So it was learning the skill on how to recognize what other people are missing in the MLS. And usually it was bad photographs telling me it was a lazy agent. So they weren't listing everything that was there. In the beginning, it was, I wanted to make offers fast. So I used speed. I wanted an offer in within an hour or two of that thing hitting the MLS. Now I've shifted to watching days on market, and as things are on the market longer, I'm making lower offers. So how do you find it? For me, it was MLS and agent searches. Super kindergarten simple. I was buying one property every couple of years, so I wasn't looking for massive deal flow. And even when it sped up to getting one every year or one every 6 year and a half or so, still all from the MLS. I don't plan on searching any other way. I see a lot of creative strategies to have that, but I am an investor, not an entrepreneur. I was not creating a job. I was taking my job to save money, to take the money to put it work in real estate. And from the MLS, it's how I'm continuing to do it. So now we've found the deal through the MLS. Before we make offers, we need to figure out how we're going to fund the deal. Right? What do you qualify for? We've talked with lenders. We've checked out our credit score, our debt to income ratio. We figured out if DSCR, asset-based seller finance are our only options, or we have to go commercial, or can we do conventional loans in our own name? Can we house hack? Do we have less than 10 so we can buy rental properties? How are you going to fund it? Look at all of those options. And every time you hear no, ask why. Somebody says we can't because your debt to income's off. Well, what can you do to change that? Or what kind of lending product doesn't look at your debt to income ratio? That's where DSCR comes in, or commercial, or seller financing that doesn't even sometimes look at your credit score. Like whatever you can get the seller to agree to. So you have to figure out what options are best for you. For me, I was going to have to save for a couple of years. I was going to have to work in a new industry for a couple of years. So I moved into an apartment and rented out my house to get rental income on my tax returns, so that 2 years later, we could look at conventional loans, small multifamily, counting the rental income from the property in my debt to income ratio so that I could buy the properties. All of that strategy happened because I talked to a lender to find out what my options were. Matt, how have you funded most of your deals? Let's go like 5-year chunks, first 5 years, next 5 years, up till today.
In the beginning, it was all banks, and it was all 20%. And before the great financial crisis, it was all bank debt, 20% investment property stuff. And then I maxed out. Fannie and Freddie went from allowing 10 loans to only allowing 4. I had 5. I had no option to buy anything more as an investment property. So my option was make everything an owner-occ. So then I did owner-occupied house hacking, where I was buying duplexes and triplexes and moving into one of the units and then renting out the other ones, and trying to basically then live for free. And so that was all done with owner-occupied pricing. And so I didn't need 20% down. And then into the next phase, then it was back to still living in those and saving up a ton of money. But then that next phase was, okay, now I can go back to, borrowing with 20% down and getting still a decent and favorable rate, because the number went back up to 10 that you were allowed to own. But then once you get past 10, then it's okay, now it's commercial debt, which is, variable rate and more expensive. So then we went to the variable rate, more expensive stuff for a lot of those assets. And then it was, okay, we got big enough where we could talk a bank into building a product with them, a small local bank. We built a product with them. And so now 85% of my portfolio is 30-year fixed rate debt. So as you continue to spend time in the business, you start to look at the more and better ways that you can run your business, which makes it more indestructible. I still need 20% down to go buy an asset, but I can get 30-year fixed rate debt if it's 4 units or less. And so that's a huge advantage. The other mistake that people make too is speed. Slow is smooth and smooth is fast. And they get their first deal and they're like, okay, I'm ready for the next one. No, you aren't. Stop it. Just stop. You aren't ready for the next one, I promise. You need to be making sure that, again, your best bet is to house hack, but if you can't house hack, it needs to be 12 to 18 months in between, because you're not building up a big enough reserve and you don't have a big enough stack sitting there. If a roof fails, if XYZ fails, and if a market gets bad, you're not going to be able to pull a HELOC. You're not going to be able to get a credit card to do that. So these are the places where I got stuck that way. I got stuck. I made too many. When I first started, I did too many transactions in too short a time. I think I did 5 in 2 years. And then when really much bigger stuff started going wrong, guess what? I didn't have the money to fix it. And so I lost a number of months of rentals because I couldn't fix what needed to be fixed because I didn't have the money. And so it was a chicken or egg thing. And I was also out of credit card space and out of HELOC space. So don't get over levered, but recognize that as you go through your process, you know what? The first few that you buy are probably going to be pretty vanilla and pretty boring, unless you can get into a position where you can do a seller finance deal. Now I've done more seller finance deals in the last 24 months than I've done in the previous 20 years. So seller financing works. It's great. But even so, you look at the source of the deals and then you look at the types of the deals that we're doing, they're just different. And what that does is, as you get more skilled and as you listen to more people and get more broad in all the different areas where there are specialists, that's going to be what helps accelerate your business, because more opportunities that come across your desk are opportunities to actually execute, as opposed to something else that's like, I just can't qualify, I couldn't get there anyway.
So we studied the market, picked an asset class. We made sure we were ready. We hunted for deals. We found deals. We figured out how to fund deals. Now we make offers. Lots and lots of offers.
Mhm.
How many times have you seen somebody, and Zuber talks about this often, where the person is just vibrating with excitement about making their offers and buying their rentals.
Mhm.
And they make 2 or 3 offers. They figure they can't ever get a deal, so they quit because they keep getting outbid and it's over, and they just don't have the luck for this. How many offers do you, in like the first 10 years of investing, would you make on a property before you got one accepted?
Oh, it was a lot. It was a lot. It was, if it's not, you're overpaying. I mean, it's usually what it meant. But yeah, I would say, oh man, 10 to 1, maybe 10 to
Okay.
1, maybe a little bit more, because we didn't know enough in that part of the game to write disrespectful offers. So we still got great deals, but we were usually getting our deals. We were creating the opportunity and creating the deal on the back end, because I could get less expensive debt. So I knew my competition was in at 7.25. I was in at 6.25. Right. And so we were making the deals on the back side of it. Also, with knowing, hey, with where we're buying and where the rents are, we know that we can increase those. We're not hoping the market goes up some next year. We know factually, because we do a rent box like we teach in the lumberjack landlord course. Because we understood what the rent box was, we're like, we know that we have something, 5 blocks away that's renting for $500 more a month times 3 units. That's an absolute crazy awesome deal. Like, we need to do this deal even if we pay list price or over list price, because the rents were so far off. So yeah, that's typically how we would do it.
That's pretty much where the binder strategy came from. I would be hunting
Absolutely.
for deals on the MLS where I knew that the owners were in that situation where they didn't want to raise rents. They were anchored mentally to their own lower rents, thinking, I can't raise it. My tenants can't handle it. I don't want to be the mean landlord. But area average rents set rents. And if I knew where my rents would be, even 5 or 10% below area average, I knew that the tenant would ask me to raise the rent to that amount and then be happy that they didn't have to move and be a part of the conversation. So we found it, we funded it, we start making offers, and your ratio is pretty good, 10 to 1. You might be better at making offers than I was. I always had the things that we're about to talk about, the contingencies in there, appraisal, inspection. I tended to make the disrespectful offer sooner. I would even, unless it just came out yesterday, I would be offering list price or maybe a little bit above, but not a bunch above. And I've seen offers go 30, 40,000 above
Sure.
day one in one of the markets I was investing in. And I would say that the math broke down to, I would look at 100 deals, 80% would lose money.
Yes.
The 20 that would make money, I would start making offers on, and I'd probably get close to the 20 and then get an offer accepted. So technically looking at 100, the newer investor usually quits before doing that. They'll look at 10
Yep.
and then they'll make one or two or three offers. And so I would make 20 to get the deal. And then it wasn't like, okay, no, I've got this. The next one I'll make an offer and get it. I do the next process is look at 100, 80 would lose money, look at the 20 to make offers, and out of those eventually get one accepted. So we make offers, be ready to be frustrated with how many you might have to make. I
Absolutely.
think Matt said it. If you get it accepted really quick, you need to sit back in your chair and go, ooh, how much did I overpay
Exactly.
in
Yeah.
this offer?
Yeah. Whoops. Yeah.
So in your offer, I include an appraisal contingency. So I want it to appraise because I'm still using conventional lending. I want it out without losing my earnest money.
Yep.
I'm going to have an inspection period. Now, this doesn't mean I have to go pay for a home inspection.
Nope.
I still do, and I have on every single one. But if you've been investing as long as Matt and you have the skills and you run the crews and done all the rehabs, you know as much as any inspector is going to find. You might get lazy and you want someone else to crawl in the places and poke the attic and all that kind of stuff and still hire one. But I want the contingency because that gives me those 5 to 10 days, depending on how long you set it in your offer, to physically go to the property because I've never been to a property before making an offer.
Mhm.
It's a declarative statement. Never been to a property without
Crazy.
making an offer as
It
an
bothers
investor.
me so much on so
Right.
many levels.
I don't know how people can do that, can go to a property and then make an offer. I just don't. I just don't. I'm looking at 100. You want me to go to 100 properties? I was working full time raising 3 kids.
No, I only want you to go to the 10 you think might make money. The other
No, I
90
make the
go
20
back.
because I make 20 offers. I get one accept. Finally, one, I've got to go actually spend some time doing this. So then I go and only I've pulled out of 2 deals ever. One was after going and looking, and the other one was I got this one and I didn't need the other. So
Yeah.
wanted to buy
Yep.
one. And I wasn't in growth phase anymore. I the inspection contingency is then I can go and look at the property and go, yep, because of this thing, I'm backing out.
Yep.
I still schedule an inspection. So that chronology is as soon as you have your offer accepted, I'll usually work with my lender and say, okay, we need to schedule the appraisal, right? And you don't get to pick the appraiser in most states. The
Nope.
lender doesn't get to pick the appraiser in most states. They go to an agency and they say, we're scheduling an appraisal so that there's no conflict of interest. They send out one of the people who are going to try to ruin your life. Because how
Mhm.
many times in your life do you think you sit there and go, I hope this thing is expensive enough for me to buy? Because that's what an appraisal is. It's an
100%
appraiser
it.
going out and saying, the thing you're trying to buy has the value high enough for the lender to risk their money. So you're hoping that they say it's
Yeah,
expensive. That would be
of
nice if it
course.
comes in 5 or 10,000 low, so you have some negotiation power, but you don't want 50,000 low. So now
Mm-mm.
you can't get lending. And
Right.
and and if the and
Seller's likely not going to sell.
seller's likely not going to sell. And now are the odds are that appraiser could be fought. Now sometimes you have to change lenders to get a new appraisal.
Yes.
And you could just have the one person in your area that isn't tracking the market. But if sometimes they might actually point out you were going to overpay,
Yeah.
and the lower appraised price is better. And I think that has saved me that one time that I backed out too. So we call to schedule those because they don't just come out tomorrow.
Mm-mm. No.
Right? There have been years where you can get them out in 3 or 4 days. And
Mhm.
then in the last couple of years, 2020, 2021, before rates went up, appraisals were $600 or $700. They jumped to $1,300, and a 3 to 5 day wait became a 15. If you were lucky, 15-day wait
You're
to get
lucky.
out there.
Yeah. You're lucky
Yeah.
2 weeks. Yeah.
So you have to know the market that you're in, and right now with the death in transactions, right? We've had this crash in real estate transactions. We normally have 6 million, and we're tracking to not even hit 4. So we've lost a third of the transactions. It might be a little easier to get your appraiser out there, but you want to have, and you do get to pick and pay this person. If you're like me and you still have an inspector go out, and I think, if you've done 5 or 10 rehabs like Matt, I don't know that you need one. But be honest with yourself. Have you? And
Right.
do you know all of the things to check for? And would you recognize things that an inspector is going to point out that aren't to code, that are safety hazards? All of the
Mhm.
things. Do you have the time to go do it? And so I usually have, I want to say 2 or 3, but it's all, a minimum of 2 home inspection companies that I deal with and have emailed several times and used on different jobs because they're not always going to be available in your inspection window. So you don't want to just have one that you rely on unless you're in a really small market and they've got a big crew. But have 2 or 3 that you can call to get scheduled to go out there. The first few, I recommend going to the home inspection being there. I don't know, Matt. So I know that you haven't recently used them. Was there a time where you used home inspectors, or did you just
Yeah,
always
we did
like
use them,
yourself?
but now we kind of talk about, one of the things that we're going to do a video on is how to get a free inspection. Because there is a way to get a free inspection. But yeah, I mean, a lot of times, when we were first in it, I didn't know a bunch about construction. I didn't know how to check a sill. I didn't know how to, check a panel. I didn't know how to check a chimney. I didn't know how to check that sort of stuff, a heating system. I didn't know how to check that stuff. Now I do. But that's where what you want to do is ideally you want to not get somebody that has been doing it, even inspections. I've been doing inspections for 5 years or 7 years. I don't care. Do you have a background in construction? Do you have a background in any of these other things? Because most of what they tell you is kind of useless, and there are very few successful lawsuits of people suing their inspectors. So you almost have to kind of take it with a grain of salt. So what I like to do is I like to make sure that they have experience in construction, in the trades, that they've done some of these things before, and then they got certified, because that's a far more valuable opinion to me than, I spent 7 days in a class and look at the shiny certificate that I got. I want to know that you've been in the trenches, that you've done some of this work, because that way, as you're going through, they have a checklist that they're literally just going right down through the checklist. And they think that they know what something bad looks like. But a lot of times they don't. I literally had an inspector that was so bad, he went through the entire report and he said, replace on literally every item. Replace. The bank literally said, we don't understand. He's basically telling you to rebuild the house. We had to fire that inspector. We had to pay for another inspection. I said, he just doesn't know what he's talking about. It looks like he'd only looked at new construction before. And so the next guy comes in, he goes, there were like 3 or 4 things like, yes, replace. And then there were some other things that, need work. But there was nothing, he didn't like do that on every line item and just be a lazy loser. Because he was trying to get his certificate points after 7 days or 2 weeks or 4 weeks. So that's one of the things I'd watch out for. But yeah, definitely an inspector.
My one caution,
Mhm.
made a video earlier. I don't know when Zuber's going to play these chronologically, about your lender and your agent not being a mentor. One of the cautions with your agent is, as a new investor, you're going to rely on your agent for things that you shouldn't, like finding a home inspector. I would not hire a home inspector that my agent provided, because is that home inspector going to worry about your business or your agent's repeat business? So if
Yes.
there's just enough in the subjective realm of this property that might make it to where you don't want to buy it, will that home inspector put all of that down because it could ruin their relationship with your agent? Or will
Mhm.
they fuzzy that area subconsciously to not ruin their relationship with your agent, to make it so that you'll follow through with the deal? Find your own home inspector. Have them make sure they have your interests, not your agent's interests at heart. And I'm not saying there's anybody unethical out there. I'm saying
Mhm.
we're humans. Part of this could be subconscious. And so it's not that hard to go find your own.
It's true. The other thing, I mean, yeah, Google it and then read the reviews. That's one of the best things to do. And if they have any reviews that say, bought this house, wished I hadn't,
Yeah.
'cause the name, the term I've always heard, I mean, you can fix anything with money. Yeah, but it's not your money. Sounds good. I will let you spend the first 50 on the building.
Right.
Sounds good. I agree. I accept. Thank you for the offer. But, yeah, you can fix, of course you can fix anything with money, but I don't want to. I don't want to fix it.
Now, for several years helping people get into real estate, here's the biggest mistake I've seen in the chronology of buying a rental that comes up not very often, but when it does, it's like, ooh, how did you not know that? I've seen investors go under contract, schedule an appraisal, schedule an inspection, and then go by with a landlord introduction letter
Mhm.
before closing. This is not what you want to do. You don't want to do a landlord introduction letter before closing. It's okay to be there for the inspection, meet the tenants, and say, yes, I'm the person trying to buy the property, but you are not the landlord. You are not the owner. And a landlord introduction letter is going to include things like how you collect rents, when, things that the seller might not want the tenants to know until it's closed. So you have to be really careful when talking to tenants. I wouldn't do the landlord introduction letter until after closing. So you now go to the inspection. The appraisal can come in before or after. So you need to look at these now. This is kind of concurrent as far as chronology goes. When the appraisal comes in, you have to look at your lender. Now, your lender doesn't go, if you're buying a place for 500,000 and it appraises for 600,000, lender doesn't call the seller and say, it appraised for 600,000. and my buyer can pay 600,000. It just says lending was approved. So you don't want to give the seller too much data for them to go, oh, well, I should charge more. You can pay more. It appraised for more. There's a gap here. When you do with your offer and you submit what is it called when you're pre-approved for lending? It's like
Pre-approval letter.
pre-approval letter. There's another term for it too. It doesn't say that if you're buying it for 500,000 and you're qualified for 600,000, it doesn't say this person can spend 600,000. Your pre-approval letter is for the amount of your offer. Your lender will make you one within less than an hour. This is part of their job, a pre-approval letter, or there's, I forget what the other term is because I know it's not pre-approval because it's not your pre-approved. It's, can't remember the other term, but it just means you're up to that amount is fine. That doesn't mean that they'll lend on that because it's still then it has to go through appraisal. So
Pre-qualified.
pre-qualified. Right. One of those is too strong. I remember I've used the wrong word before, and someone attacked me in the comments. So feel free, attack me again. Your offer included that. Now you're under contract. You have the inspection. So now the tenants know because they get notification, hey, an appraiser's coming by. Hey, we're going to schedule the home inspector. And it's sometimes kind of a fight to get them in there. I purchased a place that had a hoarder in place, and she was like, oh, you can look, but no pictures. What good is a home inspection with no pictures?
Sure.
That turned out to be a really good purchase, though.
Sometimes you unearth the pearl when you can't find it underneath the heap of trash.
I did. They had put plastic, like a Dexter murder room, and all of their stuff protected the mint condition hardwood floors under there. It was like, really? Didn't even know those were there. Great.
Well done.
So, well done, this was one where the seller made a mistake during under contract. Pay attention when you're talking to the seller if they show up and talk, because sometimes I'll be there doing things too. He explained to me how he was in a 1031 exchange and that the first deal had fallen through and he was coming close to his timeline on when he has to close on properties. Show how strong was my negotiating position, knowing that going forward. Because then after we've got that, you've got your inspection report back. So the inspector goes and does it. If you're on site, they'll give you a debrief afterwards, which means nothing because you won't retain any of it. But the next day, you'll get a 70 to 100-page report. And if you have a really bad one like Matt, make sure you read the reviews. If it's just replace, unless everything needs replaced, you should have the most important safety items first and in red that need to be addressed. And then everything after that, some points will be in red after that to get your attention. But look at those first couple of pages. These are safety items that have to be addressed. Those are your negotiation points when it comes to price. Because if the inspection comes back and there's nearly not much to do, people try to negotiate everything, but also look at the market you're in. If you're in a seller's market where they were inundated with offers and they got several good offers and they just chose yours because of some random thing. I've had one choose because it was some number was exact. A bunch of people had we were putting 5% down and my agent put 5% down, which is exactly this dollar amount. And they said that the offers were the same, except this one had the dollar amount. That was the only difference. So they had to pick mine. It could be something silly. So they accept yours. I had a point and it went away.
It happens to the best of us.
It does. Yes. And that's why
but the detail, the detail that you're talking about in the offer is important. Making sure that yours is as well communicated and as well followed or as well represented as you possibly could have it. That devil's in the details. A lot of people, hey Dion, how many people do we know that can figure out 5% in their head?
A few investors, but
very few people.
Very few, yes.
Very few people based on our experience. So having it called out like that is very helpful. It's like, okay, these people are committing $10,000, $15,000, whatever the number is. But this is the number they're committing, not just 5%. That's a big difference. That really helps communicate it best to others.
Yeah, that's one of my favorite questions is trying to get a percentage out of people when this is a percentage business. People talk cap rates, yield, cash on cash return, all of these things. And then you ask a simple question. What is 5% or 3% of this? and that goes away. Take a remedial online 10-minute math course and study what it takes to get a percentage. So now we negotiate. If there's things to negotiate, you can try to negotiate a better price. But in a seller's market, they're going to get too many offers. In a buyer's market, you have more negotiation power. But you should have only made an offer at a price you were willing to go with anyway, at an offer that made sense to you. If you can negotiate, great. You can use the hidden information of a 1031 to your advantage. You can use things from the inspection report to your advantage. You can use anything that you found after you had the offer accepted and now you got inside the building and there were things you didn't know. All the knob and tube needs replaced. The plumbing needs replaced. The water heaters are outdated. Anything you can look at and go, okay, this is kind of an expense. Ask for twice as much, never split the difference, right? If you think it's going to cost you 5,000, say, I expect it to cost 10, so I would like 10,000 off. They'll offer 5. They'll meet you in the middle usually. Learn your negotiation tactics because that's when it happens during your inspection period, but towards the end after you have as much information as you can use. Now, once you've agreed, you get told what to bring to closing.
Yes.
So the title company, we recognize, I recommend using title every time, even on a seller financed, whatever, I want title.
100%.
Okay. So
Absolutely.
you get told what to bring to closing. The seller gets told what to bring to closing or what they're going to get at closing. The title company is in charge of what day of the month are you closing on, who gets the rents up till that day, who gets the rents after. Title will take that out of the amount that's being paid to the seller off of what you bring to closing. So sometimes you might get a check saying, hey, here's the rents for the prorated portion of the month. But sometimes you're going to have your title company go, instead of 80,000, you need to bring $78,400 because you have a rent credit of whatever. They'll balance all that out. They'll figure out the interest to the day that you're closing on for the month. All of that is handled by title. Now this is where the scams happen. This is where there are some really good phishing companies out there that somehow get your data and they know that you're buying a property. So you're going to get some emails with the letterhead of your title company in the email saying, here's the accounts. And people have been, Millennial Mike had a person that just $35,000 or something was sent to the wrong account. And luckily that account had been closed because the scammers had been caught. But basically your life savings can go because you wire your money without taking the few minutes to call your actual title company and saying, read to me the numbers of the accounts that I see in my email that I'm going to be sending this money to. That's how you can do it. What I've done every time so far, because I'm old, you could tell, because I use the Just for Men. I'm as old as you get. I've not wired yet.
Oh, you bring the check?
I go get a cash
Check?
check
Yeah,
from
yeah.
your bank. If you have enough money in the bank, it's
Oh.
usually free. And if that isn't, go to a bank where it is and use them and tell your other bank to F off.
1,000%. I'm gonna let Leon finish these points with you guys because I gotta go relieve mom for an appointment that I didn't know she had.
Oh, that's all good. Yeah, we kind of went over. So
But
thanks, man.
that's okay. But no, I'm gonna leave. I'll leave this, but you can finish the top. I'll just leave and you can keep going.
Well, who's going to save me when I lose my train of thought? Thanks, man.
Oh, that should
Good
be
day.
fun. See you guys.
So now we can talk about Matt because he's not here anymore. You are bringing the stuff to close. This is, I go get a cashier's check from my bank. The title company will tell you exactly how much. If you give a cashier's check to the title company and then somehow it gets scammed, that's not a you problem. That's a them problem because you have a receipt saying it was paid. After you close, your agent will usually meet you somewhere or that keys will be dropped off so that you get keys to your new property, which I will usually not even keep because I'm going to put coded locks in all my properties. Now you've closed and you are the owner of this property. Most investors like to buy places that are vacant so that they can do a rehab and get best area average rents. I prefer to buy places that have existing tenants because that means that things like the water works, the plumbing works, usually. And I'm not going to have to do too much work. It's the lazy investing strategy. I don't do the binder strategy right away. In another video for Mike's channel here, we're going to talk about the chronology of what you do after you close on a rental. And that's everything that happens after the closing table. Thanks for hanging out with us here on One Rental at a Time. And if you ever saw this video on my channel, it's because I thought this was great content and I want to share it with you too. Ciao.